Inflation has eased sharply to 4.6% in July, putting it at a 3-year low. That's from 5.1% the previous month and below expectations of 4.9%. The reading is now within touching distance of the central bank's target. This has cemented expectations that the Reserve Bank will cut interest rates next month. DRDGold has benefited from a higher gold price. The yellow metal miner has reported a 14% rise in annual revenue. That's thanks to a 20% increase in the average gold price during the period. But this wasn't enough to significantly boost profits. Headline earnings per share rose just to 4%. That's as increased cash operating costs weighed. A final dividend of 20 cents has been declared. This is a cut of 69% when compared to last year's payout. For 2025, DRDGold has forecast output of between 155 and 165,000 ounces. Cash operating costs are seen at around 870,000 rand per kilogram, and the miner is planning total capital investment of roughly 3.5 billion rand for the year. Curro's report card is in. The private education group has posted a 16% rise in recurring headline earnings per share for the 6 months to end June. This was helped by a 0.5% rise in learner numbers, and that contributed to an 8.3% increase in revenue. No dividend has been declared. This is in line with the board's policy to distribute 20% of recurring headline earnings as an annual payout. Looking ahead, Curro says it plans to invest up to 700 million rand in capital projects this year. The funds will be used to maintain, replace and expand its facilities. That's as the group looks to meet strong demand for its services, particularly for high school tuition. South African consumers may be cash-strapped, but they're still treating themselves to a meal at Spur. The restaurants group says that while its customer count numbers remained unchanged from last year, average spend per head has grown above menu price inflation. And this has helped lift revenue by 14%. In turn, that supported an 11.4% increase in headline earnings per share. A final dividend of 118 cents has been declared. This is a 10.9% rise on the previous period's payout. Subvest Capital has delivered a 2.8% rise in net asset value per share at the halfway mark. The investment holding company says this is due to improved trading conditions which have helped alleviate demand pressures for its investees. The firm also attributes the improvement to cost-cutting exercises. An interim dividend of 35 cents per share has been declared. That's a near 17% rise on the previous period's payout. Sibanye-Stillwater has finalized a 1.8 billion rand gold prepayment deal. This will help the miner raise cash to repay loans. That's after a slump in platinum group metal prices hurt its income. CEO Neil Froneman says the prepayment deal is a proactive, strategic financing alternative that improves the company's liquidity and balance sheet. Sibanye has also reached an agreement to refinance and increase its 5.5 billion rand revolving credit facility with South African lenders, which was due to mature in November. The refinanced 6 billion rand facility will now mature in August 2027. There is an option to extend that by a further 2 years. RCL is said to wow the market. The food manufacturer says annual headline earnings per share from total operations are expected to more than double. This is better than a previous forecast that pegged a 75% increase. The growth has been attributed to strong performances from the group's groceries, sugar and rainbow divisions. RCL will open its books on the 2nd of September. Blue Label is expecting an earnings bump. The fintech group has forecast an increase in full-year headline earnings per share of as much as 77%. But the firm has tempered the good news. It says if both the positive and negative contributions from the recapitalization of Cell C in both the current and comparative years is removed, then headline earnings per share declined 35%. More detail will be available when the company publishes results. Marion Roberts' project pipeline is growing. One of its subsidiaries, Opti Power, has secured a contract as part of a joint venture with the Spanish energy infrastructure developer Coxa Bengoa. and that's to construct a solar PV renewable energy facility in the northwest for a mining company. That deals with 1.2 billion rand. Tesla has secured a significant reduction in tariffs on its China-made EVs imposed by the European Union. The EU had been considering tariffs on Chinese imports due to subsidies from Beijing, but Tesla's vehicles will now face lower tariffs compared to their competitors. Here's our reporter Anati Ndevu with more.
That's right, Zinati. Tesla won a big cut in tariffs imposed by the EU on the EVs it makes in China. Now, for months, the EU discussed tariffs on vehicles imported from China, citing subsidies from Beijing as a reason. But now Tesla and its Chinese-made electric vehicles will pay less tariffs to the EU than their rivals. And for more on this, we're joined by DW's correspondent, Wada Imran. Wada, thank you so much for your time. Tell us why the EU decided to slash tariffs for Tesla.
Thanks for having me. So there's a lot of layers to this decision and a lot of moving parts. Let's start with looking at Tesla's petition to the EU. The American automaker had requested a recalculation of its extra tariff rate, which sat at 20.8% in July. Tesla said that it received less subsidies from the Chinese government when compared to other Chinese EV makers. The EU calls these subsidies unfair, and it says that it impacts the level playing field. Brussels then looked into the claim and found that Tesla's claims were actually valid. So they did end up slashing the extra tariff from 20.8% to just 9%. Just for context, the EU is still pushing for extra tariffs up to 36.3% on other Chinese EV makers.
And what has been the reaction from China on this decision?
Well, the response from China has largely come through their Automobile Manufacturers Association. And as expected, they are not happy with the tariffs at all. The Auto Association firmly opposes the implementation of these tariffs on Chinese-made EVs. They said it brings enormous risks and uncertainty for China's operations and investment in the EU. So the mood is quite pessimistic. And today, this morning, Beijing announced an anti-subsidy probe against the EU on dairy imports. It's a classic tit-for-tat situation, but it can really complicate trade between the two entities, and that will create a hostile environment.
And this, of course, raises concerns about fair competition. So what's the sentiment there?
I mean, it could. That is something I feel China will imply in their response. But the EU is not only giving a tariff cut to Tesla, but announced revisions to 3 other companies too. BYD now faces a 17% rate instead of the 17.4% that was discussed earlier. And Chinese company Geely will receive 19.3% rate. Chinese firms that are also in joint ventures with EU producers could also be eligible for lower duties. For example, Volkswagen's Seat subsidiary could receive lower tariffs on its Cupra, which is produced in China. It's likely that these tariffs become permanent once the EU's investigation into Chinese EVs and subsidies is over. That's going to be in the next 2 months. And as per EU mechanism, these tariffs will be put to vote in front of the 27 member states. In an advisory vote in July, 12 members supported this measure and 11 abstained.
Wada, thank you so much for those updates. That was DW's correspondent, Wada Imran.